The year was 1929. The streets of New York were filled with screaming people. Men in fancy suits jumped from buildings. Families lost their homes overnight. The stock market had crashed, and nobody knew what to do. But in the middle of all this chaos, something interesting happened. While most people watched their savings disappear, a small group of investors did something different. They didn't panic. Instead, they moved their money into certain types of investments. These weren't normal investments. They were different. They were safe. And by the time the economy recovered, these investors had become extremely rich. This is the real story that nobody talks about. Fast forward to 2008. The banks were failing. People were losing their homes. The Great Recession had arrived. Again, while millions of people lost everything, some investors knew exactly what to do. They bought gold when everyone else was selling. They bought government bonds when people thought they were boring. And when the market crashed even harder, their wealth actually grew. How did they know? The answer is simple. They studied history. Every time the market crashes, the same pattern happens. And the same 6 types of investments save people's money or even make them richer. Today, we're going to tell you what those 6 investments are, but more importantly, we're going to explain why they work, how to use them, and what this means for your future. Before we talk about the 6 investments, we need to understand something important. Why do markets crash in the first place? Markets crash because of fear. When people get scared, they sell everything. When everyone sells at the same time, prices fall very quickly. This is called panic selling. It happens fast, and it happens everywhere at once. But fear isn't the only reason. Markets also crash because of too much debt. When people and companies borrow too much money, something breaks, banks fail. Companies cannot pay their bills. The whole system becomes unstable. Think of it like a house of cards. Everything looks fine when you build it carefully, but if one card falls, everything else collapses. That's what happens to the economy. One problem creates more problems, which creates even more problems. In 2008, banks gave out loans to people who couldn't pay them back. When people started missing payments, banks lost money. The banks got scared. They stopped lending money to other banks. Soon, the entire banking system was in danger. The stock market crashed 50%. People lost trillions of dollars. But here's the interesting part. While regular stocks were falling, other investments were rising. Gold prices went up. Government bonds went up. Treasury bills went up. These investments were like safe boats in a storm, while everyone else was drowning. The people in the safe boats were actually gaining money. This pattern has happened again and again throughout history. The Great Depression, the tech crash of 2000, the 2008 financial crisis, the 2020 pandemic crash. Every single time the same 6 investments protected people's money and made them richer. Now, let's talk about the 6 investments that thrive when the market crashes. These are not secrets. They are not complicated. They are simply proven ways to protect your money. Investment number 1. Gold. Gold is the king of crisis investments. When the stock market crashes, people run to gold because gold cannot go bankrupt. Gold cannot fail. Gold is real money that has kept its value for thousands of years. In 2008, when everything else was falling, gold prices climbed higher and higher. If you had bought gold in 2007 before the crash, you would have made enormous profits by 2010. Gold went from $700 per ounce to over $1,800 per ounce. That's a 150% gain, while stocks were down 50%. This is why rich people always keep some gold. They know that when everything else fails, gold will save them. Gold doesn't depend on any company's success. It doesn't depend on the government. It's just gold. And people have always wanted gold. Investment number 2. Government bonds, treasury bills. When people are scared, they want safety. They want to give their money to the safest person in the world, and the safest person is the government. Government bonds are like lending money to the government. The government promises to pay you back with interest. When the market crashes, people buy government bonds because they know the government will always pay them back. In 2008, people were so scared that they bought government bonds even though they gave almost no interest. People didn't care about making money. They just wanted to keep their money safe. This is how important safety becomes during a crash. Treasury bonds are different from regular bonds because they are backed by the US government. The US government has never defaulted on a bond payment. It has been that way for over 200 years. That's why people trust them completely. When you buy a government bond, you know exactly how much money you will get back and when you will get it. There are no surprises. There is no uncertainty. In a crash, that certainty is worth more than gold. Investment number 3. The US dollar. When people lose confidence in everything else, they run to the US dollar. The dollar is used around the world. It is the safest currency on earth. During crashes, people sell their stocks and buy dollars. They want cash. This makes the dollar very valuable. If you have dollars in your bank account when a crash happens, your money becomes more powerful. You can buy things cheaper. You can buy stocks for less money. This is an interesting thing about crashes. During crashes, prices fall. Everything costs less. If you have cash, you can buy more things. You can buy stocks at 50% off. You can buy real estate at 50% off. This is why having cash is powerful. The smartest investors always keep some money in cash. They don't put everything in stocks. They wait for the crash. Then they buy everything they can when prices are low. This is how they become rich. Investment number 4. Valuable commodities. Commodities are raw materials like oil, wheat, coffee, copper, and rare metals. When normal investments crash, some commodities actually go up in price. For example, people always need to eat. They always need oil. During a crash, people still buy these things. So companies that sell these things can still make money. Their stocks can go up even when everything else goes down. Oil is interesting because it usually goes down during crashes, not up, but other commodities often go up. Agricultural products are interesting during crashes because people always need food. Rare metals like lithium, cobalt, and copper are becoming more important. These metals are used in phones, computers, and batteries. As the world becomes more digital, these metals become more valuable. During a crash, people realize how important these materials are, and prices often go up. Investment number 5. Cryptocurrency like Bitcoin. Bitcoin is the newest investment on this list. It was created in 2009, right after the 2008 crash. Bitcoin is digital money that is not controlled by any government or bank. In 2013, when people started losing trust in banks again, Bitcoin exploded in value. People thought, I don't trust banks anymore. I want something the government can't control. Bitcoin became that investment. Are you worried about a market crash wiping out your portfolio? It's a valid concern, especially with all the uncertainty in the world today. But what if I told you there are ways to not just survive a crash, but to potentially even thrive? Stick around, because in the next few minutes, I'm going to break down some powerful strategies to protect your hard-earned money. First off, let's get one thing straight. Market crashes are a normal part of the economic cycle. They happen. The key isn't to predict exactly when the next one will hit because nobody can do that reliably. The key is to be prepared, and the most powerful tool in your preparation toolkit is diversification. Now, I know what you're thinking. Diversification. Yeah, I've heard that before, but are you diversifying correctly? Just owning a bunch of different tech stocks isn't true diversification. You need to own different types of assets that behave differently during a downturn. Let's talk about the classics first. When markets get shaky, where does smart money often run? Gold. For thousands of years, gold has been seen as a store of value. It's a physical asset that you can hold, and it doesn't depend on a company's earnings report or a government's promises. It tends to hold its value or even increase when investors are fearful and selling off stocks. Think of it as your portfolio's insurance policy. You don't buy insurance hoping your house burns down, but you're sure glad you have it if it does. Gold works in a similar way for your investments. You can invest in physical gold, like coins or bars, or you can get exposure through ETFs, which are funds that track the price of gold. It's a relatively easy way to add a layer of defense. Now, let's move from the ancient to the modern. Bitcoin. I know, it's volatile, it's controversial, but hear me out. Bitcoin is often called digital gold, and for a good reason. Like gold, it has a finite supply. There will only ever be 21 million Bitcoin. This scarcity is built into its code, which means it can't be inflated away by a central bank printing more money. During times of economic instability and currency devaluation, this characteristic becomes incredibly attractive. While it's true that Bitcoin can be volatile in the short term, many investors are starting to see it as a long-term hedge against the traditional financial system. It operates on a decentralized network, meaning no single entity controls it. This independence can be a huge advantage when trust in traditional institutions is low. Now, I'm not saying you should go all in on Bitcoin, but considering a small allocation, say 1 to 5% of your portfolio, could be a smart move to diversify against risks in the fiat currency system. It's a higher risk, higher reward play, but one that's increasingly being adopted by serious investors for its unique properties as a non-sovereign store of value. Okay, so we've covered a physical safe haven and a digital one. What about something a bit more boring? Sometimes, boring is beautiful, especially in a market crash. I'm talking about utility stocks. These are the companies that provide essential services you and I use every single day, no matter what the economy is doing. Think electricity, water, and natural gas. People don't stop turning on their lights or heating their homes just because the stock market is down. This creates a very stable and predictable demand for these companies' services. Because of this, utility stocks are known as defensive stocks. They may not give you the explosive growth of a tech startup, but they provide reliable cash flow, and they often pay consistent dividends. That dividend income can be a real lifeline for your portfolio during a downturn, providing you with cash flow when other stocks are plummeting in value. They act as a steady anchor in a stormy sea. So while everyone else is panicking about their high-flying growth stocks, your utility holdings are just quietly chugging along, paying you for your troubles. So let's recap the strategy. We're building a more resilient portfolio through smart diversification. You've got your core stock and bond holdings, of course, but then you add layers of protection. You add gold, the tried and true safe haven that has protected wealth for centuries. You add a small, speculative position in Bitcoin, the digital gold that acts as a hedge against the traditional financial system itself. And you add utility stocks, the boring but beautiful defensive plays that provide stable cash flow and dividends when you need them most. By combining these different asset classes, you're not putting all your eggs in one basket. When stocks are falling, your gold and utilities might be holding steady or even rising. Your Bitcoin position offers that asymmetric upside and a hedge against systemic risk. The goal isn't to avoid any losses at all, that's impossible. The goal is to smooth out the ride, to reduce the gut-wrenching drops, and to put yourself in a position to recover faster when the market eventually turns around, because it always does. Crashes create incredible buying opportunities for those who are prepared. When others are panic selling, a well-diversified investor can be calmly looking for bargains, ready to deploy cash, and set themselves up for the next bull run. Remember, this isn't financial advice, but a framework for you to think about and research further. Building a portfolio that can withstand a crash is about being proactive, not reactive. It's about understanding that different assets play different roles. Don't wait for the storm to hit before you decide to build an ark. Start thinking about these strategies today. Look into gold, research Bitcoin, and analyze some solid utility companies. Take control of your financial future by preparing for both the good times and the bad. Thanks for watching. If you found this helpful, do me a favor and hit that like button and subscribe for more content on how to invest smarter. Drop a comment below and let me know what your go-to defensive asset is. Stay safe and happy investing.